A major bank just gave a major warning to investors. Is it something that we should listen to? And what was the warning? Find out on this edition of the Video Market Update. So JP Morgan Chase came out with a report just a few weeks ago that said investors should brace for lower returns this year and in the next 10 years to come. Now, what I would note is they are the first of the major banks recently who have come out with that declaration. But in the past few years, we've seen other firms come out trying to warn investors that long-term growth will slow down. I think there's a few things at play. I think one, it's almost illogical to think the returns we've seen will continue, which means naturally a slowdown would come. But the idea that they're bracing investors or that investors should be worried, it's a natural part of the market. When you look at the last 2 years of 23 and 24, those are the two best years since the late 1990s. So you would have to think there would be a reversion to the mean or coming back to normal returns over the next few years. Now, UBS and Wells Fargo have analysts that believe that the market returns for this year of 25 will be somewhere between 7 to 14%. You can see here on this chart, well actually over here, you can see what the expectation for returns are generally speaking for the market. So while it may not be the high-flying 20, 25, 30% returns we've seen in the past decade, there's still optimism. Now, why is there some pessimism? A couple of reasons. One, I think post-election, the idea of the Trump trade, this idea that the market was going to trade higher because of the re-election or the election of President Trump, started to lose steam at the end of the year. And so that's made some people think, well, maybe that Trump trade didn't have a very long tail. The second is we're getting a lot of confusion and a lot of instability from the Federal Reserve of, well, we may not cut interest rates at all. We may have to increase interest rates. But then there's been others in the Fed who've said, well, we could see a couple of rate cuts. So uncertainty with the Fed certainly is going to play a role in the expectations of the market. The other is this idea that valuations have been sky high. But we just saw last week, banks came out with their earnings and they did phenomenally well. At the end of the day, it comes down to what is the performance of the companies that are in the stock market. And so all of the discussion about, well, we don't think it's going to be as good, or we think it's going to be great, or euphoria because of Trump, or pessimism because of China, it comes down to how well do companies perform. A lot of that is built on technology. A lot of that is built on AI. But a lot of it is still built on the fundamentals. And so why analysts may say, well, we might do this, or we might do that, or brace for this, or it's going to be bad, or it's going to be great, it ultimately comes down to what does the street think, meaning Wall Street. And that a lot is based on the confidence of Main Street. And so we'll continue to watch as we kind of dip our toes into the beginning of this year. The inauguration is happening, and we'll see more quarterly reports coming out from companies, and that'll give us an idea of where we're going to go. But again, it goes like this every single year. We've got peaks, we've got troughs. What we look for is, can we get some consistency and some consistent returns for investors throughout 2025. So those are just a few of my thoughts. Many more videos to come. I think there's a lot of great information we can chat about this year. But if you have questions on this video, or anything you're seeing in the market, let me know. If not, as always, I hope you make it a great week.